Welcome to this explainer. Okay, jump right in with me here and think about this for a second. If you gathered up every single personal finance and investing book ever written and stacked them all on top of each other, that pile would literally reach the moon. There is so much information out there. Yet despite millions of pages of complex jargon, mathematical formulas, and supposedly secret strategies, the actual foundational rules of building wealth, they haven't really changed in about 5,000 years. Seriously. They were completely true for ancient Babylonian merchants, and they are exactly as true for us today. So we're going to cut through all that noise, strip away the flashy marketing, and look at the absolute core principles of wealth building.
Okay, let's dive right into our roadmap for today. We'll be hitting 6 key areas. First, we'll meet Mr. Market, then look at the math of patience, see why your brain is your enemy, shatter the illusion of wealth, talk about buying time and options, and finally, wrap it up with the timeless rules. Let's kick things off with Section 1, Meet Mr. Market.
Now, you might be thinking the first step to wealth is just, saving your money, right? But saving alone is really just playing defense. If you just stash cash under your mattress, you're basically letting this silent thief called inflation slowly eat away at your wealth over time. To play offense, you absolutely have to invest. And to truly understand investing, we need to travel back to 1949 to a brilliant guy named Benjamin Graham, who wrote a legendary book called The Intelligent Investor. Graham gave us what is probably one of the greatest concepts in all of finance. I want you to imagine you've got this business partner named Mr. Market. He knocks on your office door every single day. Some days Mr. Market is absolutely euphoric, he's totally convinced the future is perfectly bright, and he offers to buy your shares for an outrageously high price. Other days, he is completely despondent. He's certain the world is ending, and he practically begs you to buy his shares at bargain basement prices. Graham's crucial lesson here is this. Mr. Market's wild tantrums and daily mood swings are there to serve you, not to guide you. When he yells out a price, he isn't telling you the true underlying value of your investment. He's just projecting his own emotional state. Your job as an intelligent investor is to just calmly ignore him and only take advantage of his offers when they actually make sense for you. And this brilliantly illustrates a refinement from Warren Buffett. Buffett actually read Graham's book when he was just 19, and he still calls it the best investing book ever written. Buffett noted that the stock market is essentially a device for transferring money from the impatient to the patient, and he meant this literally. Look, Wall Street really doesn't want you to know this, but by simply buying a broad index fund and just sitting on your hands, literally doing almost nothing, you will mathematically beat the vast majority of highly paid, highly stressed active professionals.
Which brings us right to Section 2, the math of patience. Back in 1975, a man named John Bogle founded Vanguard and created the very first index fund. And Wall Street literally laughed in his face. They mocked it as Bogle's folly. I mean, why on earth would anyone want to just match the market when they could pay an expensive expert to beat it? But Bogle knew this brutal underlying math. Look at this number, 30%. Let's say a financial advisor or an actively managed fund charges you what sounds like a tiny, insignificant fee, maybe just 1.5% a year. Sounds totally harmless, right? Well, actually, fees compound exactly the way your investments compound, just in the exact wrong direction. Over a 30-year investing lifetime, that supposedly tiny 1.5% fee is going to consume over 30% of your total potential returns. Professional investors as a giant collective group cannot beat the market, because mathematically, they essentially are the market. The entire financial industry is built on this marketing illusion that complexity equals competence. But it doesn't. Index funds work so incredibly well because you completely avoid those massive fee drains and just capture the market's natural upward growth over time.
But to actually stay patient enough to see those returns, we really need to clarify what we are actually afraid of. The financial industry loves to measure risk as volatility, basically how much a stock's price bounces up and down on a chart. That is totally wrong. If the overall market drops 20% and you own a diversified index fund, that is just temporary volatility on paper. You haven't actually lost a single dime unless you panic and hit the sell button. Real risk is permanent loss. Real risk is putting all your life savings into a single company that suddenly goes bankrupt, or needing your cash in 3 years to buy a house, leaving it in stocks and watching the market crash right when you need to write the check. Risk is simply failing to meet your financial goals when you need to.
Moving right along to Section 3, your brain is the enemy. So, once you get the basic mechanics down, you quickly realize your absolute worst enemy in investing isn't the economy, it isn't the Federal Reserve, and it definitely isn't Wall Street. It is the person looking back at you in the mirror.
Have you ever wondered why you suddenly want to sell everything the minute the market dips? Nobel Prize-winning psychologist Daniel Kahneman actually proved that humans are just not rational calculating machines. We are deeply, deeply emotional creatures. He showed that our brains basically operate on two systems. System 1 is fast, intuitive, and highly emotional. It's like our ancient, hardwired survival software. System 2 is slow, deliberate, and rational. Now, successful investing completely requires that rational System 2. But when the market crashes, your System 1 triggers the exact same fight or flight biological panic that helped your ancestors run from lions on the savannah. And conversely, when a bubble is inflating, System 1 floods your brain with dopamine, screaming at you to join the herd so you don't miss out. You are quite literally biologically wired to do the exact wrong thing at the exact wrong time with your money. Now, what's really interesting about this slide is how modern technology has just poured gasoline on those System 1 emotions. Back in 1960, the average holding period for a stock was about 8 years. Today, that has plummeted to just 5 months. We have basically turned into a society of hyperactive day traders. We're checking our portfolios on our phones every hour, reacting to news headlines that won't even matter a week from now. We are treating the stock market like a casino. But remember, in a casino, the house always wins. In investing, the patient accumulator always wins. So how on earth do we outsmart our own biology? Well, you have to build rigid systems that basically remove you from the equation entirely. Automate your investments so the right thing just happens in the background without your intervention. And perhaps most importantly, use this practical rule. Wait 30 to 90 days before making any major financial decisions after a significant life event. We're talking about things like an inheritance, a divorce, or a major career change. When your world is completely upended, you're going to feel this intense, burning urge to act immediately, but you are operating entirely out of that emotional System 1. You have to force a waiting period. Let the emotions settle down, let the immediate crisis pass, and then make your move from a place of calm, rational clarity.
All right, Section 4, the illusion of wealth.
If we actually want to be wealthy, we kind of have to unlearn everything society tells us wealth looks like. Back in 1996, the book The Millionaire Next Door completely demolished the standard American assumption of what rich people actually do. The researchers went in expecting to find millionaires driving exotic luxury cars and living in sprawling mansions. What they found was the exact opposite. Most actual millionaires run totally boring businesses, live in very modest homes, and drive 10-year-old Toyotas. They discovered this massive disconnect between what you see on the surface and what is real in the bank account. They defined two distinct groups. First, the under-accumulator of wealth, or UAW. These are the people who look incredibly rich. They might make $500,000 a year, but they spend exactly $500,000 a year on country club memberships and leased luxury SUVs. They have huge incomes, but absolutely zero actual wealth. On the flip side is the prodigious accumulator of wealth, or PAW. They don't care at all about signaling their status to neighbors, because they deeply understand that wealth is actually what you don't see. Wealth is the fancy car you decided not to buy. Wealth is accumulation, not consumption. But how do you know which group you actually fall into? Let's do a quick practical reality check right now. Here is the actual formula from the researchers to see if you are truly building wealth or if you're just spending a lot of money. Take your current age, multiply it by your pre-tax annual household income, and then divide that number by 10. That final result is your expected net worth. So, for example, if you're 50 years old and your household makes $200,000 a year, your expected net worth is $1 million. If your actual net worth is double that number, congratulations, you are a prodigious accumulator. But if it's half that, you are an under-accumulator. It's a slightly brutal but highly honest mirror to hold up to your own financial habits. And speaking of illusions, let's tackle a persistent American myth that might actually make some of you a little mad. Your house, it is not an investment. I know that sounds outrageous to some, but listen, an investment is an asset that actively generates cash flow for you. A house that you live in actively consumes your cash flow through property taxes, endless maintenance, insurance, and mortgage interest. It ties up an enormous amount of your capital in a single, highly illiquid asset. Now, yes, home ownership has wonderful, undeniable, non-financial benefits like stability and community roots, but from a pure math perspective, it is fundamentally a consumption good, not a wealth-building strategy. If you want a real investment, buy stocks, buy bonds, or buy a business.
This brings us to Section 5, buying time and options.
So if true wealth isn't about buying mansions and fancy cars, what is the actual point of all this accumulation? The classic book, Your Money or Your Life, really hit the nail on the head here. Its central insight is that we are constantly trading our finite life energy for money. Every single dollar you spend represents the actual unrecoverable hours of your life that you spent earning it. So before you buy anything, ask yourself this one powerful question. Is this thing actually worth the hours of my life it cost? Framing it this way makes so many casual purchases look completely absurd. That brand new car you just financed, that might literally cost you 2 entire years of your working life. And time is the absolute only resource you cannot get back. Now, to be clear, this doesn't mean you have to live a miserable life of total deprivation. Personal finance author Ramit Sethi has a fantastic approach for this. Cut your spending absolutely mercilessly on the things you don't actually care about so that you can turn around and spend extravagantly on the things you do love, completely guilt-free. Because frugality without a real purpose, that's just misery. And as you manage your spending, never, ever forget where your absolute highest returns are going to come from. It's not the stock market, it's not real estate. It's you. Your personal earning power is your largest asset by far. Think about it. A $5,000 course or a certification that leads to a $10,000 salary increase pays for itself in just 6 months. And then it generates infinite returns for the rest of your career. Your brain is quite literally the only asset you own that is totally 100% crash-proof. Absolutely no market recession can ever take your skills away from you.
Ultimately, you're doing all of this to achieve financial independence. And financial independence isn't about hoarding luxury. It's just about having options. It's the option to walk away from a toxic job, or the freedom to take 6 months off to care for a sick parent. But what happens when you finally reach that point where you have enough? Well, the final rule of wealth is to give back. Hoarding money endlessly is actually psychologically corrosive. Giving back expands your worldview, and it physically signals to your own brain that you have enough. It breaks that endless, stressful hamster wheel of always needing more. Remember, money isn't magic. It just magnifies who you already are. If you are a kind person, money simply gives you the resources to be incredibly kind at scale.
So, the crucial point here brings us to our final section, Section 6, the timeless roles. We've looked at the external mechanics, the underlying math, the internal psychology, and the deep philosophy of wealth. And here's the truth. The technology changes, the specific tax codes change, but human nature does not. Our brains are still running on that ancient Savannah software. We still fall for the exact same shortcuts and the exact same market panics. Which leaves us with this beautifully simple, timeless blueprint. Save at least 10% of what you make, invest it quietly in low-cost diversified index funds. Avoid bad consumer debt like the plague, build a solid 6-month emergency fund, be relentlessly, stubbornly patient, and give back. Literally everything else out there is just elaboration, marketing, or noise. You could go out and read 1,000 more finance books, and I promise you, you will continually arrive right back at this exact single page. So, if this blueprint has been identical for 5,000 years and it's sitting right here in front of you, what exactly are you waiting for to take control of your financial life?